We are on a roll out here. Now we're going to start looking at the deductions to AGI or above the line deductions. We call them adjustments. And as I told you, these are all the wishes granted to all individual taxpayers by Uncle Sam. So let's look at adjustments or deductions to AGI, or as we call them, above the line deductions. And as you know, our mnemonic for all these adjustments is wishes. So that's WISHES. Let's start with the W of wishes. Now the W is W for withdrawal. So this is for early withdrawal of savings. So withdrawal of savings penalty. So let's say you have a deposit with the bank and for some reason you have to withdraw the deposit too soon. So that's early withdrawal of your savings. Now because you early withdrew your savings, the bank charged you some penalty. That's the deduction that we're talking about here. So let's get back to the dashboard. So let's say the gross interest on this deposit that you received is $2,000. That $2,000 gross interest will get into your Schedule B and be included in gross income. But the bank charged you a penalty of $300 because you withdrew too soon. So your gross interest was $2,000, but how much did you get? $1,700. And that is where you include $2,000 in your gross income. $300 is your adjustment. Your AGI is $1,700. On page 53, we are looking at adjustments to AGI. These adjustments are above the line deductions which we see right on Schedule 1 to Form 1040. And on this page, we see put a box around Schedule 1. And the second section of Schedule 1 is highlight adjustments to income. Towards the bottom of the page, we have right our W of wishes, which is withdrawal or early withdrawal of savings penalty. Make a note there, right? Gross interest included on Schedule B. And then the penalty or right forfeited interest deducted here as an adjustment to AGI, right? Not on Schedule B. The I of wishes is IRA deduction or IRA contribution. Let me put that here. IRA contribution. So look at this. While you're working really hard, let's say you're getting your salary income, you're putting aside some portion of that salary income as towards your individual retirement account. You're contributing to your individual retirement account. Uncle Sam gives you tax benefit on this retirement savings. Uncle Sam says the amount that you've contributed to your IRA will be allowed as a deduction to AGI. It will be allowed as an adjustment. After you retire, after retirement, when you actually get the benefits, after retirement when you get the IRA distributions, only then Uncle Sam wants you to include those IRA benefits, those IRA distributions as part of your gross income. And we saw that IRAs is the I of Sir, you owe. So once again, while you're working, setting aside money for your IRA, saving for your retirement, Uncle Sam gives you tax benefits as deductions. Only after retirement, when you're getting the distributions, when you're getting the money back, that's when you pay taxes on them. So it's basically also deferral of taxes. You don't pay taxes right now because you're saving for your retirement. After retirement, and generally guys, look at this, right? So right now, when you're having a lot of salary income, you're in the high tax bracket and you get a tax deduction. After retirement, when you actually pay taxes on the IRA distributions, after retirement, you may not have the salary income. You may be in the lower tax brackets. So that could be a huge tax benefit. So guys, the rule that I told you about the contributions being deductible and you paying tax on your IRAs only after retirement when you're getting the distributions is called a traditional deductible IRA. So let's put that on my board on the other side. So we're talking about IRAs here, and let's talk about traditional deductible IRA. The question is, when you're making a contribution the contribution is allowed as a deduction. The contribution is, let me write, deductible. When you're getting distributions after retirement, that distribution is taxable as part of I of Sir you owe. Distributions, which is typically after retirement, is taxable. So both the principal and the interest, when you're setting aside money now, it's going to grow. You're going to get a higher amount after retirement. The entire amount would be taxable. The principal plus interest. Now, for the contributions that you're making to your IRA, there are going to be certain dollar limits. So for your contributions, there are going to be certain dollar limits. Now, these dollar limits, they phase out. Let's talk about phase out. Now, before we talk about phase outs, let's understand the rationale behind IRAs, the rationale behind Uncle Sam instituting the tax benefits for IRAs. The reason why Uncle Sam wants to encourage taxpayers to set aside money towards their individual retirement account. So the agenda, the rationale here was to benefit taxpayers who are not covered by an employer-sponsored pension plan. So of course, a lot of employees who are working, they're covered by an employer pension plan. The employer is taking care of the retirement savings. But let's say there are a lot of employees in the economy. Let's say there are a lot of employees who are factory workers who are not covered by an employer-sponsored pension plan. Uncle Sam really wants those guys to save for their own retirement because their employer is not saving for them. And that is where Uncle Sam wanted to have tax benefits for IRAs so that they were encouraged, they were motivated to set aside money for their retirement. So when we talk about phase out for traditional deductible IRA, we will see that if the employer has no pension plan, so if the taxpayer's employer has no pension plan for the taxpayer, the traditional deductible IRA does not phase out. So the phase out will happen only when the employer has plan. Let me use a red pen for this. So you see it loud and clear. Plus the taxpayer is rich. That means the AGI of the taxpayer is above certain thresholds. So what we are saying here is the phase out for the contribution limit to a traditional deductible IRA will happen only if both the conditions are met. Number one, the taxpayer's employer has a pension plan. And number two, the taxpayer is earning money beyond certain levels. So the employer has, as we say, pension plan. So if the taxpayer's employer does not have a pension plan, then there is no phase out for the taxpayer for the traditional deductible IRA. Now, for the rich guys whose employers have a pension plan, typically we see phase outs. They're not able to contribute to traditional deductible IRA, but they may still be able to contribute to Roth IRA, which was instituted by Senator Roth. So let's look at Roth IRA. Roth IRA is different. It's exciting. Now, Roth IRA, what happens here is when you as a taxpayer make contributions to your Roth IRA, it is not tax deductible. That's the bad news. You get no tax benefits right now. So you're putting aside money for your Roth IRA, you do not get this deduction. So this deduction, the IRA contributions that we have here, is only the contributions into your traditional deductible IRA. This one. If you do contributions to your Roth IRA, there's no tax deduction. That's the bad news. However, for Roth IRA, the good news is when you get the benefits, when you get the distributions from your IRA after retirement, all those benefits and distributions will be non-taxable. So you're not allowed a deduction here. The bad news. The good news is you won't even have to pay tax when you receive the distributions. So when you set aside money into your IRA, you set aside so much of money. Over the years, until you retire, the money grows. After retirement, you get all those, the huge amount of money as IRA benefits, as IRA distributions. So when you set aside a small amount of money, you didn't get a deduction for that. After retirement, when that principal grows and there's principal plus interest and you're getting all of that back, the good news is you don't have to pay tax on them. So for Roth IRA, the contributions are non-deductible. That's the bad news. The distributions are also non-taxable, and that's the good news. Now, when we talk about phase outs for traditional deductible IRA, we said phase out is when employer has a pension plan and the taxpayer is rich. For Roth IRA, the thresholds that we have for rich are even more. So let us say if very rich. So until you're very rich, your thresholds here for AGI are going to be way higher. You can contribute to Roth IRA. Now, for the filthy rich guys who can't do traditional deductible IRA because let's say their employer have a pension plan for them, who can't do Roth IRA because they've breached even the Roth IRA AGI thresholds. For those filthy rich guys, the option for IRA that we have is a non-deductible IRA. Now, when you look at this non-deductible IRA, as the name suggests, these are non-deductible. So the contributions that the taxpayer makes to those IRAs is non-deductible. And even after retirement, when the taxpayer is receiving the IRA distributions, so the taxpayer contributed the principal, the smudge, it grew, the taxpayer after retirement is getting all the benefits, the interest portion will be taxable. The principal, of course, is the return of capital, right? The taxpayer set aside so much of money, gets more than that. The principal will be non-taxable because it is a return of capital. but the interest on traditional deductible IRA will be taxable. So let's say partially taxable. Let's say the interest portion. So as you realize, right, when I compare Roth IRA and non-deductible IRA, in case of Roth IRA, the entire distribution after retirement, everything is tax-free. But for the non-deductible IRA, for the filthy rich guys, they don't need all those tax benefits. For them, when they get the money after retirement, they still pay tax. They pay tax on the interest portion of the IRA. Basically, the IRA distributions for them are partially taxable. So, we've spoken about contribution for IRA. We've spoken about all the contributions, right? And we spoke about dollar limits, phase out. Let's talk about distributions. So, typically, when you look at IRAs, the distributions for IRAs happen after 59 and a half. And just to highlight this more, let me use the red pen. The distributions typically happen after 59 and a half years. Now, there could be situations where you could early withdraw your IRA. So, instead of waiting till you become 59 and a half, 60, you can early withdraw your IRA. Now, if you early withdraw your IRA, you may have to pay penalty, let's say a 10% penalty, and tax on distributions. Now, if it's a traditional deductible IRA, tax is okay because the distributions would anyways be taxable even after 59 and a half years. But the penalty, that would really pinch you. Think about a Roth IRA. Penalty is bad and you're also having to pay tax on distribution. So that's going to really pinch you. But there could be scenarios where you're allowed by Uncle Sam to early withdraw your IRA. There could be scenarios where there's no penalty and no tax. Let's say you're trying to buy your first house. Uncle Sam says you can take some money from your IRA. Let's say death or disability. Uncle Sam says no problem, you can early withdraw your IRA. Now, there could be other scenarios where there's no penalty but there's tax on distributions. So let's say you're going to meet your college expenses. Your medical expenses are too high, beyond a certain level. You don't have a job, you're unemployed, and you have to pay for your medical insurance. So there are some scenarios where Uncle Sam allows exceptions for early withdrawal of IRA. But generally, IRA, as the name suggests, individual retirement account, are basically to be withdrawn, are basically to be distributed only after you're ready to retire. Now, one last thing that we have here is rollovers. Let's say you invest in a traditional deductible IRA, or rather, there could be situations where you invested in a non-deductible IRA and you could convert them into Roth IRA. So let's talk about traditional deductible IRA to Roth IRA. You're trying to convert this to this. Now, if you realize when you did traditional deductible IRA, you had gotten a deduction for all your contributions. Now, if you're trying to convert a traditional deductible IRA into Roth IRA, you'll have to reverse all the deductions that you have taken. Right? Once again, so traditional deductible IRA, you get deductions on contributions, which is not allowed under Roth. So if you have to move this to this, all the deductions that you've taken will now have to be added back to your income. You'll have to pay extra tax because you're trying to roll over. You're trying to change from traditional deductible IRA to Roth IRA. Again, that's an option that you could have as a taxpayer. Now, before we get to the book, one last thing. Let's get to the dashboard. So what we're saying here is for IRAs, when you're making contribution to your IRA, that's the I of wishes, you get a deduction to AGI. Now, over and above this deduction to AGI, your contributions to IRAs also lead to certain tax credits. So when we get your tax credits, your mnemonic will be ACE foreign business winner. The S of Deers is going to be savers credit. This is going to be the credit for all those taxpayers who save for their retirement. So you're going to get a deduction to AGI as well as a tax credit for your retirement savings. On page 54, we've got IRA deduction, which is right, the I of wishes. Let's first look at, put a box around traditional deductible IRA. For contributions, the question is whether it's highlight a deductible adjustment. And the answer for traditional deductible IRA is highlight yes. And right there, wishes, circle I of wishes, because that's the IRA deduction for traditional deductible IRA. Taxpayers have to contribute to the traditional deductible IRA by circle 15th April, which is the actual due date for filing the 1040. Now for traditional deductible IRA, the next question is, are there highlight taxes on distribution? And the answer for traditional deductible IRA for principal as well as earnings is highlight yes and yes. Draw a bracket there, right? Sir, you owe and circle the I. So the I of Sir, you owe is where the distributions from traditional deductible IRA are included onto the individual's gross income. Next, put a box around Roth IRA. And for Roth IRA, draw an arrow and write no tax impact now or later. So for deduction on contribution for Roth IRA, highlight no, because they are right, not deductible now. Even for distribution for Roth IRA, highlight no for principal and no for earnings. Draw a bracket and write there not taxable later. So Roth IRA is neither deductible now when the individual is making contributions, nor will it be taxable later when the individual receives the distributions. Next, put a box around non-deductible IRA. So as far as deduction on contribution is concerned, non-deductible IRA, right, not deductible now. As far as taxes on distribution is concerned, for non-deductible IRA, put a bracket around no for principal and yes for earnings, and right there, interest is taxable later. Next, highlight contribution dollar limits. So the combined limit for all the IRAs is highlight $5,500. It's going to be highlight $11,000 if married filing jointly. Highlight for individuals over 50 years of age, additional $1,000 contribution is allowed. Now there is highlight a phase out for IRAs. Now the phase out for traditional deductible IRA applies circle only if underline participant in employer sponsored pension plan or Keogh plan. So the phase out for traditional deductible IRA will happen only if, right, employer has plan plus rich. For Roth IRA, the phase out applies to all but with higher limits so that the rich can contribute. The phase out for Roth IRA would happen, right, if very rich. Next, we're looking at highlight distribution age limits for IRAs and highlight after 59 and a half years. Penalty on highlight early withdrawal of IRAs. There is highlight a 10% penalty plus tax on distribution. Now, traditional deductible IRA is anyways taxed. So in case of early withdrawal, you lose only penalty. Now there are highlight qualified early withdrawal for IRAs. Scenario where there is no penalty and no tax is underlined a home buyer first time where he early withdraws $10,000 from his IRA for use in 120 days. Underline death or disability. So these are situations where qualified early withdrawal is allowed. There's no penalty, there's no tax. But situations where there's no penalty but there is tax, of course tax is okay for traditional. These scenarios for no penalty plus tax include underline higher or college education qualified expense. Underline medical expenses in excess of 10% of AGI, or underline medical insurance for 12 weeks unemployed. Now for IRAs, besides deduction, there is also highlight tax credit. So it's basically both, right? Deduction and credit. So the individual can additionally claim highlight savers credit, which is also called the retirement savings contribution credit. Right there. ASDRs equals foreign business winner and circle the S of DEERS because that one's savers credit. Now for rollovers, taxpayers may highlight convert traditional IRA to a Roth IRA, and this could be done by underline paying taxes on any previous contribution deductions, because these contribution deductions which were allowed for traditional deductible IRA would not have been allowed for Roth IRA. Move to page 55, where we've got a few variations of IRAs, which again have, right, no tax impact now or later, which is, right, similar to Roth IRA. So on the first column there, we have put a box around Coverdell. So that's Coverdell Education Savings Account or Education IRA. The next one is Qualified Tuition Program. Put a box around QTP. Now for both Coverdell as well as QTP, the question is the contribution highlight deductible? And the answer is no. The next question is, are there highlight taxes on distribution? And again, the answer is no, as long as the distributions are used to pay highlight qualified education expenses. And towards the bottom of the page, we're talking about tax credit for Coverdell as well as QTP.
highlight can claim education credit, which is the American Opportunity Tax Credit or Lifetime Learning Credit for the same beneficiary, provided the same expenses are not used. So the taxpayer here has an option. Either the taxpayer can take a tax-free distribution of Coverdell or QTP to pay the qualified education expenses, or the taxpayer can claim a tax credit for those qualified education expenses. If the taxpayer chooses to take a tax credit, that's going to be the E of ACE. So the ACE dears equals foreign business winner, and circle the E of ACE because that's education credits. Now move back up on the page and look at the last column, which is about, put a box around able accounts. This is pursuant to the ABLE Act, Achieving a Better Life Experience Act of 2014. This is a savings program for an eligible individual with blindness or disability who is a designated beneficiary. The question is there a deductible adjustment allowed on contribution? The answer is highlight no. Again, the question is, are there taxes on distribution? And the answer is no, as long as the tax-free distributions are used to pay highlight qualified disability expenses. So we see for able accounts, there's no tax impact. There's no deduction on contribution as well as no taxes on distribution. Now scroll down on the page and let's look at tax credit for able accounts. So for able accounts, the taxpayer can additionally claim highlight savers credit, which is the retirement savings contribution credit. So here the taxpayer is getting both, a tax-free distribution and a tax credit. And right there, ACE dears equals foreign business winner, and circle the S of dears because that one's savers credit, the retirement savings contribution credit.
We've spoken about payroll taxes, which Uncle Sam imposes on all those who are working as of today, all the salaried guys. The payroll taxes are imposed pursuant to FICA or the Federal Insurance Contributions Act. What Uncle Sam does is, why are these payroll taxes, FICA taxes? Uncle Sam gets a lot of money. Uncle Sam uses all of that money to give out benefits to those who are retired as of today or those who are disabled as of today. So let's say those who are retired, they get social security benefits from Uncle Sam. Those who are retired, they get Medicare benefits from Uncle Sam. And we spoke about social security benefits, didn't we? That's the S of Sir You Owe. So Uncle Sam is collecting payroll taxes, FICA taxes from the working professionals, from the salaried guys, using that money to give out social security benefits, to give out Medicare to those retired and disabled folks. So let's talk about the percentage of payroll taxes. So as we talk about payroll taxes or FICA contributions, let me put that up here. When you look at FICA contributions by the employees, all those who are employed as of today, FICA contributions have two parts or two pieces. One piece is FICA Social Security, and the second piece is FICA Medicare. FICA Social Security, the employee pays 6.2%. FICA Medicare, the employee pays 1.45%. Total, the employee is typically paying 7.65%. This number could increase if the employee's income is above a threshold, but let's talk about general rule. 6.2% plus 1.45%, that's 7.65% for the employee. And I also told you employers make a matching contribution. So generally it's a similar contribution by the employer. So employee is paying 6.2% FICA Social Security, employer pays 6.2%. Employee 1.45 for Medicare, another 1.45 here. So the total that you have is 7.65% by the employee and another 7.65% by the employer. So tons and tons of payroll taxes being collected by Uncle Sam, and of course Uncle Sam uses that to provide social security benefits to those who are retired, to provide Medicare benefits to those who are retired as of today. Now let's talk about the self-employed individuals, the business guys. They don't get salary income, and of course, when they retire, they'll also be eligible for social security benefits and Medicare benefits. So Uncle Sam basically looks at them, and Uncle Sam realizes that the self-employed guys are actually playing a double role. They are the employee and they are their own employer. They're their own boss. So they are employee plus employer. And Uncle Sam says, because the self-employed guys are playing a double role, they're employee plus employer, they need to pay taxes. They need to pay self-employment taxes, which is 7.65 plus 7.65, 15.3% self-employment tax. So they pay the 15.3% self-employment tax in lieu of payroll taxes. These guys, the self-employed guys, they don't get a salary from the business. Whatever the business income is, 15.3% self-employment tax for them. Now, before we talk again about the self-employed folks, let me give you an example of salaried guys, the employees, and how the deduction for FICA happens from their paycheck and how the employer makes a matching contribution. So let's say we're talking about an employee whose salary is, let's say, $100,000. Now, from that $100,000 salary, the employee needs to make 7.65% contribution to FICA. So the employee would have to contribute, let's say, 7650. So 100,000 minus 7650. The in hand for the employee would be 100 minus 7650 is 92,350. I mean, there could of course be federal income tax withholdings and all of that, but right now we're just focusing on the FICA contribution. So 100,000 minus 7650 is 92,350, which is in hand, which is what the employee sees. Now, what we said is, besides the employee contributing this 7.65%, 7650, the employer has to make another matching contribution. So the employer will also have to pay 7650 towards FICA. Now, if you realize, let's talk about both the employee and the employer and how they're doing their tax returns. So let's talk about the employee. The employee is actually having a salary of $100,000. The money he's getting is only 92,350. Now, the employee, when he's filing out his 1040, when the employee is doing his 1040, he's going to include that entire $100,000 in his gross income. on his tax return, on the employee's tax return, the employee does not get any deduction for the payroll taxes, for the FICA taxes paid by the employee. So once again, though the employee got only 92,350 in hand, his gross income, W2 income, is going to be 100,000 on 1040. Now let's talk about what's happening with the employer. The employer, for the employer, the salary is $100,000. So the salary expense on the employer's tax books is going to be $100,000. Plus the employer on his accounting books is going to account for payroll taxes which the employer has paid of 7650. So on his profit and loss account, on the employer's income statement, for financial accounting purposes as well as for tax purposes, the employer will have an expense of 100,000 plus 7650, which is 107,650. So if you realize what's happened here is the employee did not get any deduction for the FICA taxes, for the payroll taxes the employee paid on the employee's individual tax return. But when the employer could be a sole proprietor, employer could be a partnership, a corporation, but when the employer paid payroll taxes, the employer got the deduction for those payroll taxes, for those FICA taxes. Now, when we come to the self-employed guys, when Uncle Sam imposed 15.3% self-employment tax on those self-employed guys, they went to Uncle Sam. They went and met him. They told him, look, you're charging us this 15.3% self-employment tax, which is a lot of money, which is still fine because you're charging this in lieu of payroll taxes. But at least give us some deduction. And Uncle Sam said, okay, self-employed guys, you're playing a double role. Once again, you're the employee and you are the employer. And we were clear, an employee is not going to get a deduction for FICA taxes on his tax return. But the employer, we saw, did get the deduction for 100,000 plus 7650 on his tax return. So what Uncle Sam said is, self-employed folks, you will get a deduction for the FICA taxes, for the payroll taxes, rather, in their case, self-employment taxes that you've paid. But you will get a deduction only to the tune of the employer's portion. So when we look at our adjustments to AGI and we get to the S, the first S of wishes, this stands for self-employment, self-employed folks. So let's talk this. So S is for self-employed folks. The first part here is the self-employment tax. Now, not the entire amount, not the entire 15.3, no. They only get a deduction of the employer's portion. They get a deduction only for this portion, the 7.65%. So self-employment tax, employer's portion only. So they get a deduction for this part, which the employers got in case of payroll taxes. So they're getting this as a deduction. So a self-employed guy who's filling out a Schedule C for his business income, when he's doing his adjustments to AGI, he or she is going to have a self-employment tax deduction out here for the employer's portion, which is about half. There could be situations where it could be less than half, but let's say about half. Let me say about 50%. Let me say approx 50% of the self-employment tax. Now, for the self-employed folks, besides getting a deduction for the self-employment tax out here, not the entire self-employment tax, only the employer's portion of the self-employment tax, they also get a few more deductions for the benefits for the self-employed individual. Let's talk about those benefits. Let's first talk about health insurance. Now, when we look at salaried employees, who takes care of health insurance? Typically, it's the employer taking care of health insurance. And when the employer is taking care of health insurance, for the employee, it's a non-taxable fringe benefit. Now, for a salaried individual again, who takes care of their retirement benefits, of their pensions? Again, employer takes care. And for the employee, this is again a non-taxable fringe benefit. So we saw that under wages and salaries. We saw a whole bunch of non-taxable fringe benefits where the employer was taking care of the employee and the employee did not have to pay taxes on that. Now, coming back to self-employed folks, who's going to take care of them? Do they have an employer? No, they are their own employer. That's what we said. They're playing the double role. They have to take care of themselves. They will have to pay for their own health insurance. They will have to pay for their own retirement plans. So what Uncle Sam says is, for these self-employed guys who have to take care of themselves, when they pay for their health insurance or when they invest in their retirement plans, they could create a KEOG plan, an HR10 plan. So when the self-employed guys take care of themselves, the amount that they spend will be allowed to them as a deduction to AGI as an adjustment. So the S of wishes that we have here is number one, the employer's portion of the self-employment tax plus the benefits for the self-employed guys. So the S of wishes, the first S, is all about self-employed individuals.
On page 56, we're looking at the S of wishes. So on the top left, write S. And here we've got self-employment tax and benefits for the self-employed. For self-employment tax, draw an arrow and write deduct only employer's portion. And then we've got benefits for the self-employed, which are not deductible on Schedule C. On the first bullet, highlight self-employment taxes. Since self-employed individuals work for themselves, they are required to pay both the employer's and employees' share of FICA. And right there, self-employed equals employer plus employee. Next, we've got the calculation of the self-employment tax rate on Schedule SE. Underline, total self-employment tax is 15.3%, which includes, underline, FICA Social Security, which is 6.2% employer share plus 6.2% employee share. And then we've got, underline, FICA Medicare, which is 1.45% employer share plus 1.45% employee share. The total is 7.65% for employer, plus 7.65% for employee. And draw a bracket. This calculates to 15.3% self-employment tax. Now, self-employed individuals are highlight allowed to deduct the employer's portion of self-employment taxes paid by them. And the employer's portion is right 7.65%. In short, this is underlined 50% deduction for FICA Social Security and 50% or less for Medicare. On the next bullet, we have put a box around self-employed and highlight health insurance deduction. And this is underlined 100% deductible by self-employed individuals. Next, we've got put a box around self-employed and highlight retirement plans. So self-employed individuals can contribute to their own retirement plans, where underline contributions are non-taxable, subject to dollar limits. So self-employed individuals may set up following kinds of retirement plans. They could do highlight SEP IRA. So this is the simplified employee pension individual retirement arrangement. They could do highlight simple. So this is savings incentive match plan for employees. They could do qualified plans, also called highlight HR10 plans or kiosk plans. So basically, when we are looking at self-employed health insurance deduction or the self-employed retirement plans, put a bracket around both of these and right there, self-paid as no employer to pay. So the self-employed guys have to pay this themselves, and that's why they get a deduction, because they've got no employer to pay. They are self.
You want to have a health savings account to take care of expenses which are not covered by your insurance. Let's say there's an insurance deductible. You've had a surgery, you've paid $30,000 for the surgery. Out of $30,000, the insurance company reimburses you $29,000 because the remaining $1,000 is your insurance deductible. Now, you could take that insurance deductible out of your health savings account. Let's say you're going and buying prescription drugs, not covered by insurance. You could use the money from your health savings account. Let's say you're going for vision care. You could use money from your health savings account. Let's say you're going to a dentist for dental care. Again, you could use money from your health savings account. So health savings account helps you with a lot of your medical health expenses, again, which are typically not covered by insurance. Often, employers set up health savings account for the employees. And we discussed when we spoke about wages and salaries that the health savings account contribution by the employer is a non-taxable fringe benefit. So let's say on your offer letter that you have from your employer, the employer says that he's going to give you a $100,000 salary and a $3,000 contribution into your health savings account. Your CTC is 100 plus 3, that's 103. But on your gross income, you only will have 100 because the 3,000 that the employer is putting into your health savings account is a non-taxable fringe benefit for you. However, let's imagine a situation where your employer does not want to put money into your health savings account. The employer is fine giving you the entire 103 in cash. He's like, you take the entire 103, figure out whatever you want to do with it. You can take care of your own HSA if you want to. Now, if the employer is giving you 103 now, your gross income, your wage income will become 103. In the first case, the employer was still spending 103 on you, but he was giving you 100, 3,000 was into your health savings account. Now, the employer is giving you the 103, but he is not taking charge of your HSA. Now, in this case, you could take care of your own health savings account. And Uncle Sam allows you deduction. So the H of wishes under adjustments, deductions to AGI, this one's HSA. So the deduction to AGI for your health savings account would apply only when you're paying for your health savings account from your pocket. It's hitting you. If your employer again was contributing to your HSA, it would be a non-taxable fringe benefit. But if your employer is not doing that and you have to take care of your HSA, then you could claim a deduction to AGI. So let's get to the numbers. So what we're saying here is if the employer took care of your HSA, your gross income was 100. But in the second case, when the employer says, take the entire 103 and do whatever you want, and you have to take care of your own health savings account, and let's say you decide to put $3,000 into your health savings account, that $3,000 you could claim as an adjustment. So the adjustment basically would be the H of wishes. Your AGI now would be 100, which is the same as when the employer took care of your health savings account.
On page 57, we're looking at the H of wishes. So on the top left, write H, because we've got HSAs here, or the health savings account. So if the health savings account payment is paid by employee or a self-employed individual, it is deductible expense. Basically, it's an above the line deduction, or it's an adjustment to get to AGI. However, if the HSA payment is underlined by employer, that's a non-taxable fringe benefit. So write there, non-taxable income.
Often we are amazed at how much educators and school teachers spend from their own pockets to buy treats, prizes, awards, snacks, and crafts for their students. Though those educators may not get reimbursed, they do this because they love their jobs, they love their kids. Uncle Sam is also impressed, and he offers a little tax break to the educators as educator expenses, and that is the E of wishes. So let's put that here. So herein, as part of educator expenses, an eligible educator, let's say a school teacher, can deduct any unreimbursed portion of expenses for books, supplies, computer equipment, other equipment, and supplementary materials used in the class. Note, the deduction here, the adjustment to AGI, is only for the unreimbursed portion, something which the school teacher educator spent from his or her pocket and did not get reimbursed.
Back on page 57, we've got educator expenses, which is the E of wishes. This is applicable for underline elementary and secondary school teachers. And this deduction is for underline unreimbursed expenses for books, classroom material, supplies, or computer equipment.
As an ambitious, independent adult, you've taken a student loan to pay for your college fees and for your boarding expenses. You really deserve a pat on the back. And this pat on the back comes in from Uncle Sam in the form of a tax deduction that you get for your student loan interest. So the student loan interest deduction is the second S of wishes, an adjustment or deduction to AGI. So let me put that here. Student interest loan deduction. And with this, we've completed our mnemonic wishes. All your wishes which Uncle Sam has granted to you for you to claim a deduction to AGI.
Back again on page 57, we've got the student education loan interest deduction, which is the second S of wishes. So right there, S, and this deduction is for underline education loan for qualified education expenses, includes room and board.
You have all your wishes granted by Uncle Sam, but you want more. Uncle Sam's smiling and gives you a few more brownies, a few more deductions to AGI. So let's make a mnemonic wishes at all.
On page 58, we are looking at the other adjustments to AGI. So on the top left, write at all. So this is wishes at all. And the first one here is highlight alimony paid. Now make a note there, right? For divorces from 2019 and highlight from 2019, right? No tax impact for alimony. Therefore, right, if husband pays alimony to ex-wife, for the right ex-wife, it's a non-taxable income. And therefore, right, for husband, it is non-deductible expense. And highlight this, it's a non-deductible expense for the husband. It is no longer an adjustment to AGI. However, right, for divorces up to 2018, for the ex-wife, it is taxable income. And right, for the husband, the alimony paid is a deductible expense, or within brackets, an adjustment to AGI. And highlight this. So for the husband, alimony paid is a deductible expense, an adjustment to AGI. This was applicable or continues to be applicable for divorces which have happened up to 2018. On the next bullet, we've got highlight moving expenses. So moving expenses as an adjustment to AGI was suspended by the Tax Cut and Jobs Act for most taxpayers. However, the deduction continues to apply, highlight only for members of armed forces on active duty who move because of a permanent change in station due to a military order. On the next bullet, we've got domestic production activities deduction, DPAD, and scratch it off because DPAD is underlined repealed by the Tax Cut and Jobs Act. Move to page 59. And here we've got tuition and fees. Scratch it off because tuition and fees as an adjustment to AGI is now expired, can no longer claim it. On the next bullet, we've got discrimination suit costs as an adjustment to AGI. So if the taxpayer receives an award for age, race, sex discrimination cases being non-physical in nature, they are included in gross income. Hence, the taxpayer is allowed to deduct any attorney's fees and court costs underlined only to the extent award received. So right on the gross income, we're going to include punitive damages received. And deduction to AGI or an adjustment would be right attorney fees plus court costs. And draw an arrow up because these deductions are allowed only to the extent award received. Next, we've got jury duty fees remitted to employer as an adjustment to AGI. So if employers pay employees for the time when the employee was performing jury services, employers have the right to require employees to remit back to them the jury duty fees which was received by the employee. Now the jury duty fee is included in gross income along with any employer contribution or employer salary for that period. Hence, the jury duty fees which is remitted back to the employer is a deduction. So right there, in gross income, the employee will have wages received on W2 plus jury duty fee as other income. So the employee who's acting as a jurist would have both the wages and the jury duty fee on their gross income. And therefore, they have deduction to AGI, where the deduction is allowed for the jury duty fees which was remitted back to the employer.